Hey there, awesome accounting student. Mark Frankel here. In this video, I'm going to talk about inventory cost flow assumptions. This is chapter 5 for Accounting 101. This applies to companies that sell products, Barbie dolls, or cowboy boots, or teddy bears, or anything that we call tangible personal property, something you can touch, something you can use. And the reason we have to deal with this is because we need to have a systematic way of tracking the cost of these items. If we lived in a world where there was no inflation, which means there were no changes in prices, this wouldn't be necessary. But that's not reality. We do live in a world where prices change, and they can go up or they can go down. In most cases, historically, prices have gone up, and that's what we call inflation. But in some cases, we might have deflation. Typically, electronics get cheaper over time because of changes in technology. But the point is, when prices change, we have to have a systematic way of tracking those prices. And so we have 4 ways to do that. We have FIFO, which stands for first in, first out. LIFO, which stands for last in, first out. We have an average, which is the average of the inventory items, and we have specific identification. Now, what makes the most sense for non-perishable items, and we're going to use an example for a bicycle, which is obviously non-perishable. First in, first out makes the most sense because what you're doing is you're selling the oldest inventory first. And that makes sense just from the standpoint of rotating stock. So you want the oldest stuff to go out first, so that what's in stock is usually the newest stuff. That makes sense. And that's the way most companies do physical flow of their goods. Physical flow means that they are actually using a FIFO assumption where the oldest goods are sold first. But that doesn't necessarily mean we have to use the same physical flow assumption for what we do in accounting. We can actually, if we're in the milk business, we would always, of course, want to sell the oldest stuff first. But if we were the accountants for the milk company, we could use LIFO or average or probably not specific identification. So LIFO is really designed in an inflationary environment to save tax. So the reason we teach this typically in an accounting class is because we can use this for tax purposes. But the IRS does say if you use it for tax purposes, you have to also use it for book purposes. In other words, we couldn't use FIFO on our books and then LIFO on our tax return. We have to be consistent between what we do for our books and what we do for our tax returns. Average is for companies that sell bulk items, nuts, bolts, and screws. Home Depot has lots of stuff. It would be really difficult and not cost beneficial to use FIFO for nuts and bolts and screws and screwdrivers and that kind of thing. Excuse me. An average cost or weighted average would be appropriate for companies that sell bulk items. And then specific identification is designed for companies where they sell items that are serialized. Serialized means that they have a unique number, identification number of some sort. Think about a car that has a VIN number, or a truck, or a refrigerator has a serial number. Anything that has serial numbers where we can track specific things that we sell, then we can use the specific identification method. So the example that I'm going to use here is some bicycles. We have 3 bicycles that we bought. And of course, we're a bike shop. And we bought the first bicycle on the 5th of January and paid $100 for it. The second bicycle, which is exactly the same bicycle, so keep in mind these are exactly the same things. The only thing that's different is the cost. So on the 12th of January, we bought a second bicycle for $120. And the third bike we bought on the 25th of January and paid $140. Now, the inflation rate is pretty high here, but this is for illustration purposes. So, we sold 2 bicycles. And let's just say we sold those 2 bicycles on the 28th of January. In other words, we had all 3 bicycles that were in our shop ready to be sold, and we sold 2 of them. Regardless of physically which 2 we sold, if we use a FIFO basis for costing, that means that we would sell the January 5th and the January 12th bikes. The cost is 100 plus 120, which is 220, and our gross profit would be 280, and the bike in ending inventory would be the bike we bought on the 25th. That's $140. If we were using a LIFO cost flow assumption, we sold 2 bikes towards the end of the month. And if we're using LIFO, that means from a costing standpoint, we sold the last 2 bikes that we bought, which is the bike that cost $120 on the 12th and the bike that cost $140 on the 25th. So our cost of goods sold would be $260, and our gross profit would be $240, or $40 less than the FIFO method. So here's where you can see we would save taxes because our profit is lower using FIFO in an inflationary environment. For the average cost, we're going to take all 3 bikes and add them up. So it's 100 plus 120 plus 140. That's $360. And if we divide it by 3, that means our average is $120. We sold 2, that's $240. And our gross profit is $260. Our ending inventory would be the average cost of 1 bike, which is $120. And then if we use specific identification, we sold our 2 bikes, we could say, well, because we have a serial number, we know we sold A158 and we know we sold A252, so that's $240, 100 plus 140. Our cost of goods sold is $240, and gross profit would be $260. Now, this is just by coincidence the same as average, but again, that's just because of the numbers that I'm using. So, ending inventory would be 1 bike, which is, and let me open this up, there it is, would be our middle bike, which is the bike that's $120, A189. So this is how these 4 methods work: FIFO, LIFO, average, and specific identification. And this is it for this video. I will do another video on using problem 5.1b that illustrates this in a textbook problem. So that would be next. Thanks for listening, and I'll see you again next time. Bye-bye.